Today I have some very good news for some of you who might be interested in learning how you can make money even though you're having a mortgage on your new house. And I have with me as my guest Brad Villers. Thank you so much for being here.
Thanks for having me.
And he's going to explain a special program that's somewhat unique and offers an opportunity for buyers to make money from their mortgage.
That's exactly right. So what we're doing is we're using a couple of tried and true financial vehicles basically that have been around for a long time. And we're basically turning the traditional amortizing mortgage on its head. We're replacing the amortizing mortgage and basically giving a homeowner a lot more freedom and control over their money and be able to do things that they simply can't do with an amortizing mortgage. And this is very personal to me because I have gone decades not knowing this. Just came across this information fairly recently. And it's really amazing the kind of control that you can get back and the kind of financial future that you can create when you use these tools.
Okay, so if it's this financially great for people, why have we not heard more about it? And are there just a unique little sector that it applies to? Or what can you kind of shed some light on so we know what we're doing?
It's a great question. I get that so many times. People say, why haven't I heard of this? And the simple fact is it's because there's a lot more money to be made in the traditional mortgage market. We're talking about big financial institutions. They make a lot of money doing this. And what I would say is we do a lot of education, and one of the things that we teach our clients is that an amortizing mortgage, the traditional 30-year mortgage, is great. It has some really unique features, and it's really good especially to get people in homes, but as a methodology and a vehicle to finance your home over a long term, over decades, it is probably one of the worst things for a homeowner. It's great for the lender, it's great for the bank, but it's not great for the homeowner.
Because of how much more they're paying with
Absolutely.
the long-term interest? Okay.
Great point. Because of how much they're paying in interest, they have no control over what their payment is. With an amortizing mortgage, as you well know, you've got the payment. The payment is going to be divided between principal and interest, but it's the same payment every month for that term of that loan. Well, you replace that with a different kind of financing vehicle. Basically, you can have control over how much interest you pay. Sounds crazy, but it's true. And the other thing I would say is that the people that it works for, it's not everyone. So it takes a particular type of homeowner for this to work, and we basically call it a financially disciplined homeowner. And so that means they spend less than what they make, they have a good credit score, and they have some equity in their home.
Okay, how much equity does it take to do this program?
20%.
Okay, so same thing, some savvy buyers put down at least 20% to avoid the PMI,
Right.
And so it's those same people might be a good candidate.
That's right, and the thing that I would say is there are components to this mechanism, this plan, the strategy, and one of them is replacing the amortizing mortgage with a different type of borrowing vehicle, and that is what I call the engine. And then there's the fuel, and the fuel is how much you make over what you spend. So the more a household brings in an income over what they spend, the faster they pay off their home and the less interest they end up paying for.
This may be a crazy question that makes no sense at all, and you can say, Carol, that's not part of the program. Let's say that I'm making really good money and I'm participating in this program. Can I pay more than what and kind of catch up on my mortgage? Like, people might pay more toward their principal on a regular mortgage.
Right. Yes. The simple answer is yes. And unlike making additional principal payments on a regular mortgage where you're basically shortening the length of the mortgage, but you're not really impacting how much interest you're paying, with this system you can. Because you can take additional income that you have. For example, it's not required, but if our clients have savings, if they have money just sitting in a checking or savings account, we encourage them and we'll tell them that they have the option of applying that mortgages or that money as well into this financing vehicle, and it will pay off even quicker. They do not have to, but it is available for them. And I would also say one other thing is people will say, well, I have the security of having that money in the bank, I know it's there, but with the kind of financing vehicle we're talking about that replaces the mortgage, they have access to that money. And again, that's another positive over a regular amortizing mortgage where When you make those additional payments, it goes to the mortgage company and it's gone.
So they can kind of borrow from themselves.
That's exactly right.
Okay, that makes sense. Is there a minimum amount that they have to pay each month?
So no.
Like say I had a horrible month and no income really, and I'd been sick or whatever, and I'm like, I just don't feel like I can make a payment at all this month.
So there are payments that have to be made, but they are much smaller than what are on a traditional amortizing mortgage, and they're interest-only payments. So they're going to be much smaller. And we work with families who have their K-1 or 1099, and their income varies, and that's fine. As long as over time, over a year, they have enough money to offset their expenses by that margin that we need, it works.
So let's hypothetically say I buy a $500,000 home.
Mm-hmm.
I put 20% down and I'm on a standard mortgage. Mm-hmm. So I have this set principal and interest, and of course taxes if I escrow or if I pay it at the end of the year, whatever I'm doing, okay? And then versus you, and I've got the same 20% down, what should I expect monthly or for 6 months or whatever? Or does it just depend on how I want to play the game?
It just depends on how you want to play the game.
Okay.
It's a very specific, and we run into this a lot because people will give us a scenario and they'll say, well, what will it look like for me? And we really have to run their specific numbers. And it only takes, by the way, 8 pieces of data, very simple data. I'm not talking about social security numbers or anything like that. It takes 8 pieces of data for us to run it through our system, and in 30 seconds we can tell you whether or not it will work.
So just as an example, what kind of data points are you looking at?
We're looking for income and their expenses. We're looking for how much they owe on their home, what their home is worth, what their interest rate is. Things like that. It's very basic data. And I will also add something else that we can put into this program, although it's based on a mortgage, and the mortgage is really the engine, as I talked about before. This process of how we're running cash flow more efficiently can be used to pay off other consumer debt. So we have families who come to us and they have a mortgage, but they also have cars, or they have a boat, or they have an RV, or maybe
a medical bill.
Medical bills,
something they didn't
loans,
expect. Yeah.
They have something else, and we can add that as well.
Wow.
Yeah.
Are we at a point where you just want to get more and more people involved in this kind of program? Is it that available, I guess?
Yeah, it is.
Okay.
It's available. It's available in Texas, as well as all the other states.
Wow.
And so all we ask is that people reach out and actually share the data with us. That's something that we really have gotten a little bit more disciplined about wanting.
Sure.
Because it is so hard to deal in the abstract.
I understand
We
that.
really want to need to know their individual circumstances and get those 8 pieces of data. And from that, we can share with them whether it'll work, whether it won't. And if it doesn't, sometimes it's just a small tweak or a small adjustment. Maybe they just need a little bit more income, or maybe expenses need to come down a little bit, and it might work for them.
Okay. So, Brad, as we sum this up or whatever, tell me what kind of benefit or advantage you're seeing for your clients.
So our average client comes to us with a mortgage that still has between 25 and 29 years remaining, and we're able to show them how to pay that off between 5 and 7 years. They save an average of $100,000 in interest expense, which is typically more, and we show them how to convert what was their mortgage payment. Now they won't have one anymore after the 5 or 7 years. We show them how to convert that into typically 6 figures of tax-advantaged retirement income.
Wow.
For the remainder of their life.
Okay. Good news.
I'm Brad Villers. My company is Sophia Financial Solutions. You can reach me at gbv@sophiafs.com, or you can call me at 713-417-5353.
Great. Thank you.
Thank you, Carol.
Thanks for joining me today.
Appreciate it.